Invito a Neil Lloyd, Head of US, DC and Financial Wellness Research de Mercer, Estados Unidos, para que nos hable sobre Behavioral Finance y su efecto en los portafolios de pensiones.
Buenos dias. And a particular welcome to the very distinguished guests that I know we have here today. And thanks for inviting me to Cartagena. It's really great to be here. So my topic for today is behavioral finance and its impact on pension portfolios. And the reason I think this is such a critical topic is that it helps to explain how individuals engage or not engage with pension portfolios, and helps us to design more effective pension portfolios, particularly defined contribution systems. It also helps us to explain why sometimes the products that we think will really help people don't sell, they don't take. And it helps us to explain how fiduciaries act, who often are our key clients. It helps us also to explain how investment professionals act, and that can help us with different opportunities. One, we can potentially exploit their biases, and it can also give us a chance to actually potentially improve our own performance. Okay. Now, I don't have a clicker, so hopefully this will work. So today I'm going to give a brief introduction to the topic. I'm going to talk a little bit about how behavioral finance impacts participants and fiduciary decision making. But I'm also going to talk about how it impacts investment decision making as well. But first, in case you don't know who Mercer is, I thought I'd share this one slide. And it talks about how we try to enhance the health, wealth, and careers of more than 110 million people worldwide. But the key issue for me with this slide is the fact that it focuses on individuals. And the key with behavioral finance is we need an understanding of behavioral finance to understand how individuals will react and how they will engage. So I'm going to go through an introduction. When I was studying economics, I was taught that in classical economic theory, people were free, rational, utility-maximizing individuals with a given set of preferences, endowments, or trusts. I actually think the last T was technology, so I may have actually lost the mark if I was answering this question. But if you look at that description, does that sound like people we know? It sounds very robotic, like the picture. Maybe a more realistic picture is this one, where we don't trust the idea of going to the person who offers free hugs, but rather we get in a queue and we'll line up for $5 to get a luxury hug. Or maybe we'll drive for 20 minutes to get a 35% discount on an iPod worth $100. But when we get offered a 3.5% discount on an iPad, we're not prepared to make that drive. Yet we all know the same amount is $35. Yet I'm sure I can see myself making this mistake and driving the 20 minutes for the iPod. Now this picture is myself and it's Lindsay who works with me. And we use this ultimatum game to try and indicate some of the behavioral decision-making issues we see. And the way the game works is there's a one-time offer of $1,000. So there's one time, and you get one time to answer the question. I get to decide how much I get and how much Lindsay gets. If Lindsay accepts what I say, we both get that allocation. If Lindsay says no, then we both get nothing. So in the first question, I offer Lindsay $200, and I'm going to keep $800. So someone's shaking their heads already. So if you were Lindsay, would you accept that offer? By show of hands. Somebody would surely accept the offer. Okay, there's a couple of you. You get the point. If you go one step further and we make the comparison $450 versus $550, you actually find that most people will actually accept that deal if they were Lindsay. But let's try a third one. If the deal was $100,000 and I offered you $20,000 and I was going to keep $80,000, how many of you would keep the $20,000? Okay, by show of hands, I'm sure actually probably in reality most of you would take it. Now what this game shows, the rational answer is Lindsay should accept any deal that I give her, because whatever I give her is more than nothing. But in reality, we don't. And what actually comes into the equation is we actually put a value on fairness. And this experiment has been reproduced across the world. And what actually happens is, when the offer is below 20%, in about half the cases, people reject the offer. But what happens is, as the number gets closer to being a fair number, you find the rejection rate falls away. And then when the amount is significantly larger, then actually people accept it. So it highlights that we put this value on or we add fairness into our equation, but also potentially with the large number, maybe we can be bought. Now this is a slide which talks about some different behavioral biases. And we're going to go through some of these in the presentation. But just to give you an idea, behavioral finance is not a folly. Taylor, Kahneman, and Schiller have all earned Nobel Prizes for their work in behavioral finance, and in fact Richard Taylor did last year. So I'm going to start off with the endowment effect, and this is one of my favorites. So what happens is, we give a group of people, we give them all a pen. And the endowment effect is seeing how you value what it is that you have. So we give them a pen, and we say, okay, we're now going to offer you a mug. So give me the pen back, I'll give you a mug. And with that offer, we found out that 10% take the mug. We're going to switch it around. Different group of people. We say to them, you got a mug, and now we're going to offer you a pen. And when you do it this way around, 12% take the pen. And it shows how we hang on to what we have, and that has a higher value than what we don't have. And you'll see later, I'll make an example when I reference annuities, where this can make a big difference. Overconfidence, the best way to prove this, I could ask you to put up your hands if you thought you were an above average driver, and probably 70% of you would think you're above average drivers. You're not. Not that many anyway. Montier did an experiment, he asked fund managers, and basically, again, 70+% of them thought they were above average. Hyperbolic discounting, bit of a mouthful this one, but this basically talks about how we overvalue short-term rewards relative to what happens down the line. So we struggle with long-term trade-offs. Simple example, which would you choose, $100 today or $105 in a week? Most people take the $100, even though the $105 probably is a better offer. But if we change the question and we say, which would you choose, $100 in a year's time or $105 in a year and a week, people take the $105. But this is a very, very important issue, because if you look at individuals, they would rather spend now than save later. So their preference will probably not be to save for retirement, and that's something we need to overcome. Prospect theory and loss aversion, and in fact Kahneman actually earned his Nobel Prize for prospect theory, talks about how people value gains and losses differently. And the particular answer they found is that investors will tend to sell winners too quickly and keep losers too long. So they want to make sure they actually lock in that win, but they don't want to actually book that loss at some point in time. And I've seen this with fiduciaries or committees, where they get very concerned about seeing book value losses, whereas really their concern should be what's going to be the future performance. So as I said, behavioral finance has a lot of impacts. It impacts participant decision-making and investment management, which is really going to be my main focus. But also it impacts advisors, providers, other technical experts as well, and we need to be aware of that. One of the great successes of the defined contribution market has been inertia. So what we do is we don't ask people, we auto-enroll them into a pension plan. Because they don't actually end up changing their minds, they actually stay in that pension plan and they stay in there. That works a lot better than trying to get people to enroll. Target date funds, Matt will talk about it later, but they do a similar approach because they actually adjust the investment allocation automatically for people. Auto-escalation is very successful. We bring them in at a 3% contribution rate, and then we gradually increase it each year, and because people don't react, the next thing they're putting away a very nice contribution rate. Another example was Benazzi and Taylor. They developed a scheme called Save More Tomorrow. So they took into account the status quo bias, or this inertia effect, and they also looked at trying to overcome this hyperbolic discounting, the fact that people didn't want to save today. So they said, let's save tomorrow. So let's tell people, why don't you save at your next pay increase? So when your next pay increase comes around, we'll increase your contribution. And what was interesting was 78% of the participants actually adopted it. 80% of those people were still in that program after the fourth pay rise. And actually, you can see the contributions went from 3.5% up to 13.6% over 3 years. That makes a huge difference in terms of retirement adequacy when you can actually have that take place. This is an example, and actually this one I know, I've used this with, it's actually a US record keeper example, and it's about anchoring and framing. So basically they basically allow you with a click of like a mouse to decide which contribution rate you want to enroll at. In this example, 4%, 6%, or 8%. So just maybe someone can call out, which contribution rate do you think most people would select? 4%, 6%, 8%. Okay, I think I'm going to hear the 6 more than anything else, so we'll go with that. And if it was 8, 10, 12, what do you think? Okay, I can't hear that well, but I'll go with, generally when we do this discussion, most people think it's the middle answer. When I did it, I came up and I said it's the middle answer, of course it is. The truth is, most people actually select the first number. They select the, and we can debate why it is they select the lowest contribution rate, but when you know that, if we want people to contribute at, say, 6% going forward, then we know that we need to say 6, 7, 8, or 6, 8, 10, because that's the way you're going to get people to contribute at 6%. Another example of framing, different sort of investor mixes, and you can see the average equity allocation changed just because of what options were put in place. And in fact, you might guess the answer here, but what actually happened was most people actually just chose 50-50 mix of the two funds. And in fact, there's a funny story. It's Harry Markowitz, who was a Nobel laureate, the founder of modern portfolio theory, said he was presented with this choice. And he says he knows that he should have gone and calculated covariances. He knows he should have calculated an efficient frontier. But in the end, he just went 50-50 between equities and bonds. Now, Shabra is one that I actually really like, and is one of my favorites. Shabra talks about risks having three components. It's more complex than what Markowitz had. There's personal risk, which is making sure that, really making sure that you can protect yourself, that your standard of living does not fall. Market risk is actually having assets that keep pace with everyone else, or keeping up with your peers. And aspirational risk or assets is wanting to have something which enables you to jump a long way ahead. There's only jump ahead of your peers, so actually really having great success. And the aspirational risk aspect is why we see lotteries being so popular. But what's also interesting is when I look at, I spend a lot of time looking at retirement income products. I find they're totally focused on personal risk. But if you look at those products, they can actually be a little bit boring. And I think the more we think about market risk and maybe some things that maybe have some aspirational ideas, that may actually be a lot more attractive. And we've actually seen the products like that. Even if they're not necessarily as smart, they're actually more attractive to people. The wealth effect is another important one. And I mentioned the wealth and endowment effects. I mentioned annuities earlier. Probably the best case of this is that, having built up a certain amount of wealth, there's surveys that say that people want lifetime income or annuities when they retire, but it tends to be younger people. When you get to people when they're older, you actually find that's less the case, or their affinity to having an annuity actually declines. And one of the reasons is they finally generated wealth. And they don't want to give up on that wealth they have. So can you imagine a person, they probably have built up the biggest financial asset they've ever had in their life. It might be $100,000 or whatever the number is. The idea of taking that and giving it to someone else is just not going to happen. I think that's one of the reasons why annuities aren't so successful. There's another issue, though, that we've begun to see, and this is a new one, is that the wealth effect of having a pension plan potentially leads to you feeling wealthier and potentially spending more. So in this study, they actually found that having auto-enrolled people into a pension plan, people were actually taking out higher auto loans and mortgages. So people were feeling wealthier and potentially spending a little bit more. And although it's not commented on in Australia, I mean, this was some research done in 2013. Oops, lost my sound. And in 2013, what they found was that the increase in pension assets from the Australian system was pretty much exactly the same as the increase in debt that occurred over the same period. So there was really a concern that the fact that people had pension balances was leading them to then actually finance a higher standard of living. Now, one of the things is this is an international conference. There's lots of people from lots of countries in here. And it's worth being aware that behavioral tendencies aren't always the same. So you can't see this that well. But just to give you an example, this was looking at investor patience. And interestingly, Colombia and the US were pretty much in the middle. Canada, which is actually where I live, they were actually more patient investors. And interestingly, Chile was one on the least patient side. Now, I'm not going to make any comments on this, but I'm sure we can debate this a little bit later over a cocktail. We then looked at, well, this study looked at loss aversion as well. And again, a similar picture. We saw Colombia and the US being quite similar. We saw Canada being actually not very tolerant of losses. We did have, actually Chile is in there somewhere, but the one that was actually quite interesting to me, and I actually was born in Britain, is that the British were the ones who were most tolerant of losses. Well, in fact, Australia was more tolerant, but I was surprised the British were like that. And then to finish, we looked at this inclination to bet on an extremely unlikely event with a very positive outcome. And this is this aspirational idea. You know, how can I get something where I really actually do very well out of it? And the interesting one here, is the picture of where Colombia is. So we had the US and the Canada in the middle, but Colombia came up as a very high inclination towards this bet. And again, you can debate this with me later. You can go and see the research. But maybe if this is true, maybe that's something you can take into account when you're designing products. So let me talk on about investment managers. Are behavioral problems new to the investment world? No. There was tulip mania in Holland in the 1630s. My wife's here, and she loves tulips. I like tulips as well. But this got a little bit out of hand. It actually got to the stage where a single tulip was actually more expensive than the average salary of a skilled worker. People were actually selling their houses to go and buy this tulip. And of course, what happened was eventually the bubble burst, and in 1637, they were left with pretty flowers, but no houses, and quite a big problem. So behavioral issues have happened before. I mentioned confidence earlier. Barber and Odin equated confidence with trading activity. The more you trade, they felt you were more confident. You see here, least active traders, very low turnover, high return. The most active traders, a much lower return. So no value gained from that overconfidence. Low volatility equity strategies. What we generally expect is that the higher risk, the higher the return, the lower the risk, the lower the return. This chart shows the MSCI World Index. The lighter blue line shows the MSCI World Minimum Volatility Index. And you can actually look at the numbers, and you'll find the minimum volatility index, the less risky index, gives you less risk and actually gave you a higher return. And we can sit here and debate this and why this is the case, but it's a behavioral phenomenon to be aware of. So how can we address this? I always think, ask Warren Buffett. Unfortunately, I don't have his number, so I end up relying on what is written and what he quotes. And he talks about having a sound framework for decisions, and that will then help you to keep emotions out of that situation. Another approach, and we'll talk about this, is you can actually sit there and actually analyze the trades that a manager has. And with this, you can actually identify behavioral biases. So for example, you can look at an investment manager, and you can find out where is it they add value. Is it on buying shares or is it on selling shares? And I find this quite interesting because if I look at myself, I have a feeling that I would be good at buying shares. I'm not convinced I'll be good at selling shares, and that's why I'm not an investment manager. But if you can actually get to that answer, that can be very powerful. It can change the way you structure your investment team to be more efficient. Another example is people, when they trade, they have a habit of trading not just all in one day, but they'll do it over 3 phases, over 3 days, or they'll buy over 3 days. Well, if you do some analysis and you go and find that every single time it's your first buy or your first sell which is the most successful, you can change your trading practices to affect that. The other example, and I know about this in companies, you do find there are some portfolio managers who are really good at buying, like I think I might be, and there are others who are better at selling. Again, you can change the structure to make that work for you. And in fact, this company, Cabot, I mean, this is all they do. They specialize in looking at investment management firms, and they talk about it adding roughly 45 basis points per year in terms of performance, which is quite significant. I'll show you another example, and this comes from an investment company that I like them a lot. I mean, I've known them for a long time, and they have a very simple philosophy. They buy shares where they believe there's 50% upside and 1/3 downside. But they're concerned that their portfolio managers will fall in love with the shares that they have. So they've introduced a discipline. If the share goes up by 50%, they sell 1/3. Doesn't matter who it is. They will sell it immediately, they sell 1/3. If the share falls more than 1/3, they pass it off to a new analyst. Now, this approach is not the approach I would recommend for everybody. What does, it actually works really, really well with this one specific company. But it's a great example about they knew what their biases were, they knew what their challenges potentially were, and this actually made their life a lot easier. So coming to the conclusion, I hope what I've shown you is that behavioral finance is essential to try and explain how individuals interact with pension products, with pension plans, and other financial products. An understanding of behavioral finance actually helps us to potentially put forward products that people actually really want. And I think that I've seen that a challenge a lot of the times is we actually focus on what we think people need, not on actually what they actually are really looking for. Also, I think by using behavioral finance, by using things and putting in place auto-enrollment, things like target date funds, things like auto-escalation, they all significantly improve the DC system as we have it. But there's more to be done. And as we continue to enhance the DC system, we need to do more than just defaults, and behavioral finance will help us in that. In terms of investment managers, similar story. I mean, for them, I mean, if you can see these behavioral biases in the market itself, that's what a lot of quantitative managers do, and you can actually exploit them. If you recognize your own, you can potentially improve your performance and maybe make you a success where you would not have been a success otherwise. I will leave you with one issue to ponder, though. If you look at the future, and in the future more investment decisions will be made with AI, machine learning, and issues like that, it's going to be interesting to see, I mean, does behavioral finance disappear? And I don't think it does. I'm not convinced that, with things like AI and machine learning, there will be biases. They may not be the same as we've seen before, but they will exist. And having the same ability to understand them, to analyze them, will actually help you greatly. So with that, muchas gracias.